Hey there, welcome to Wealth and Weight. What I'm about to share with you is something every retail investor in precious metals needs to understand. Something extraordinary has been unfolding in the silver markets, and mainstream media isn't talking about it. Over the past several weeks, we've witnessed massive quantities of physical silver being requested for actual delivery, not just traded on paper, but actually claimed and removed from warehouses. The scale is staggering, especially since this wasn't supposed to be a major delivery period. This suggests institutional players, governments, or major industrial consumers are aggressively securing physical metal. Today, I'm breaking down exactly what happened, why this matters more than daily price movements, and why the coming phase could unfold faster than most expect. Quick request, if you appreciate original analysis, subscribe right now and comment "Wealth in Weight" so I know who's engaged. Also, I've set up a WhatsApp channel for real-time updates, link in the description. The physical delivery surge. Let's get to the core issue. Enormous amounts of physical silver have been standing for delivery month after month at levels that fundamentally change the market conversation. Most people view silver as just a price chart. That's the mistake. The real story is the gap between paper contracts and actual metal. You see this when major players stop rolling futures and demand, "I want the actual metal." Here's what happened. In 1 month, approximately 70 million ounces were demanded for delivery. The next month, tens of millions more. Combined, we're approaching 100 million ounces claimed in a compressed time frame. This isn't routine trading. This isn't retail speculation. This is strategic accumulation with one huge implication. Someone is choosing physical metal over paper exposure. Ask yourself, who does this at such scale? A sovereign entity building reserves? Industrial buyers prioritizing supply security? Funds positioning ahead of the market? Share your theory in the comments. Paper versus physical, the real vulnerability. Futures markets create an illusion of unlimited supply because contracts get recycled repeatedly. That generates volume, liquidity, and fees. It works because most traders never request delivery. They close positions, roll contracts, or cash settle. But when too many participants say, "I want the physical silver," everything changes. Paper is easy to create, but physical metal is not. This is why delivery behavior matters more than price. Prices can be managed, but you can't fake removing metal from supply without revealing strain. When contracts reach delivery, buyers can stand for delivery instead of closing. That means requesting actual silver bars, not just paper exposure. When enough buyers do this, the system tightens because markets can create contracts quickly but cannot produce refined metal quickly. Who's behind this? Imagine you're a large manufacturer. You need silver for production. Your factory is running, customers are waiting. Then you hear supply is tightening. If you get caught short, you don't just lose a trade, you lose production, customers, market share. So what do? You secure a stockpile. You overorder. You pay premiums because the cost of being wrong is bigger than the cost of paying up. Governments think the same way. They think in terms of vulnerabilities and strategic materials. If silver is critical, they stockpile quietly. They restrict exports. They prioritize domestic needs. Add investment funds. They see currency debasement, deficits, instability. They want assets that aren't someone else's liability. Some don't just want exposure. They want to eliminate counterparty risk by taking physical delivery. When funds, industry, and governments all pull in the same direction, something breaks. The system vulnerability. The paper market works when physical demand stays modest, but when claims multiply while physical supply is steady or shrinking, the ratio becomes a problem. Markets resolve this through repricing, rationing, or rule changes, sometimes all three. When you see delivery requests in tens of millions of ounces repeatedly, you're watching a behavior change, and behavior change precedes structural change. Some buyers are even skipping Western markets entirely, going directly to producers, paying premiums to secure flow. When buyers fear future availability, they stop optimizing for price and start optimizing for certainty. That's a classic scarcity signal. Here's the critical question. If the biggest buyers are accumulating quietly, who's on the other side? Every contract has a seller. Every ounce demanded creates a liability somewhere. If sellers assumed contracts would roll but they're being delivered against, they're forced to source metal in a tighter environment. That's where stress builds. Market evolution timeline. People want dates. I can't give you magic predictions, but I can show you how these situations typically unfold. First, physical tightness shows in delivery behavior, premiums, procurement. Second, policy tightness emerges, export restrictions, strategic classifications. Third, price tightness appears, resistance breaks, gaps, violent moves. Fourth, narrative tightness, media discovers the story. Everyone acts surprised. We're between phases 1 and 2. That's why watching now matters. If you're still locked in, type wealth and weight in the comments. It helps the algorithm and shows me who's engaged. Why silver is unique. Silver sits at the intersection of money and industry. Gold is mostly monetary. Copper is mostly industrial. Silver is both, monetary enough to be hoarded, industrial enough to be consumed. That makes it explosive in a world electrifying everything. Solar, electronics, defense tech, sensors, automation, all lean on silver. When the pipeline tightens, pressure spreads. Here's the thing about industrial demand. A solar panel factory can't install paper silver. A defense contractor can't wire circuits with paper promises. They need physical atoms. When industrial demand acts like a buyer of last resort, price discovery stops being orderly. The supply challenge, silver supply is weird. Most global production isn't from primary silver mines, it's a byproduct of mining copper, lead, and zinc. That means silver supply doesn't scale quickly with silver prices. Even if prices surge, supply doesn't instantly respond. Add this: silver gets consumed. Unlike gold that sits in vaults and gets recycled, silver is used in tiny quantities in millions of products. It's often not worth recycling. It ends up dispersed, in landfills, effectively gone. So silver scarcity isn't just mining, it's physics and economics. Once consumed, it's hard to recover. Years of demand exceeding supply drain inventories, thin buffers, reduce resilience. Then a small shock becomes a major crisis. The currency factor. Part of why metals get revalued isn't that metals change, it's that the measuring stick breaks. Comparing currencies against each other often hides the truth. A more honest comparison is measuring currency against hard assets, gold, silver, things that can't be printed. When you see gold and silver rising, sometimes that's not them getting stronger, it's currency getting weaker. That weakness is built into a debt-driven system that expands money supply over time. Connect this to delivery trends. If sophisticated buyers believe currency will keep eroding and physical supply is tightening, what do? They front-run. They accumulate. They eliminate counterparty risk. They take possession before the public understands why. What should you do? Here's what a small investor should do with this information. First, don't panic. Second, stop letting daily candles distract you from structural signals. Third, think about exposure and control. If you own something depending on promises, you carry counterparty risk. If you own something physical, you reduce it. I'm not telling you what to buy, I'm showing you what to monitor. Delivery volumes, inventory movements, export rules, industrial procurement. Those are the levers that matter when markets transition from paper games to real supply fights. The next phase. If industrial buyers feel insecure, they don't buy incrementally. They buy aggressively. They lock contracts. They build stockpiles. They shift from just in time to just in case. That creates an accelerant effect pushing prices beyond what charts predict. Funds chasing performance will notice. They'll see metals outperforming, see breakouts, see momentum. They'll pile in. Then retail arrives asking, why is silver moving? The answer, because it was moving behind the scenes for months while you watched the wrong signals. The biggest buyers prefer silence. If a market is tight and you want to accumulate, you don't advertise. You buy quietly, spread across channels, use intermediaries. You let price stay calm as long as possible because once the crowd catches on, premiums skyrocket. That's why this period is valuable. It's not the final mania stage. It's the quiet accumulation stage. Key tracking framework. Track 3 layers. Layer 1, physical flow, deliveries, withdrawals, inventory changes. Layer 2, policy, export rules, strategic classifications, refining bottlenecks. Layer 3, psychology. When the crowd understands the first two, they react emotionally. That's when volatility spikes. Track these, and you won't get whipsawed by daily noise. Final thoughts. We're in a world where multiple regions want supply security, electrification increases silver demand, defense and high-tech needs don't slow down because prices rise, and mining supply is constrained by geology. permitting, politics, and the byproduct nature of most production. That's not a recipe for stability. It's a recipe for periodic shocks. And delivery behavior tells you big players are positioning for those shocks now. I'm not trying to alarm you. I'm trying to prepare you. Preparation is calm. Panic is ignoring signals until the last minute. Key takeaway. Remember this. The surge in delivery demand recurring across months at massive scale suggests strategic accumulation. Once that becomes a trend, it feeds on itself because every buyer arriving later pays more. Take action. If you found value here, do two things. First, subscribe so you don't miss updates. This is moving fast. Second, comment your theory about who's taking delivery or just wealth and weight to show support. If you want more silver coverage with this detail, deliveries, supply chain, policy moves, let me know in the comments. Take care of yourselves. This is Wealth and Weight, and I'll see you in the next one.